Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Now, just a quick question from an individual here. Do we need a certain volume, open interest to trade these options? The observation is that there's low volume on most of these options, and ultimately, anytime you're looking at a new series of option contracts, initially there is going to be a low volume as people become more comfortable and confident in those particular options. But one thing that the ISC has done very effectively is they've put market makers in place that are very good at keeping the spread differentials quite reasonable between the bid and the ask prices. And at the end of the day, that's really what we need to be concerned about as retail traders, is whether or not we can get in and out at prices that are fair with these option contracts to us. So even though you may see that there's relatively low volume on these contracts, it's the market maker that's in place to do business with us. We don't have to worry about whether or not there's 50,000 other people interested in trading these markets. It's the market maker that is in place to ultimately take the other side of the trade. And so in that respect, the market maker, and as I said, what the ISC has done is they've really done a good job at ensuring that the market maker is creating a tradable market and a tradable spread differential between the two strategies. So certainly when you go in and you look to execute a trade, what I do is I always try to split the difference. I always try to go in, and if the market maker really wants to do business, then I put my limit order in, and I let it just sit there, and ultimately, if they're interested, then they'll take the other side of the trade. They'll split the difference. So that's one way that you can look to offset the spread difference between the two strategies. But certainly, I found in my experience that this market to be very tradable. Hopefully that answers your question. So moving forward here, guys, let's take a look, just as an example, looking at the CDD. And in fact, I snapped this chart yesterday, and this was essentially what my observation was on the U.S. dollar versus the Canadian dollar. Very much expecting there to be a pop or a continuation to the upside. And so the idea was that if we really wanted to trade our views, you can see on our chart here, and I'll just try to just bear with me here. You can see on our chart here that what we're really looking at is the CDD at the time sitting around that 103.35 level, and our outlook is essentially that we believe that the U.S. dollar is going to strengthen against the Canadian dollar, and as such, in order to trade our views very simply, we would go out and we would buy a call option, because as we know, a call option will increase in value as the pair value increases. And so in sticking with our sort of general rule of thumb, what we would look to do is buy that CDD September 104 call. Now, this would be a call option that would be considered at to slightly out of the money, with the underlying security being sitting at 103.35, or the pair value sitting at 103.35. We would be looking at the CDD 104 strike call option. Now, as you can see here, the price of that CDD strike call option is listed at $2.47. Now, we have to understand that we have a multiplier of 100, which suggests that we're going to pay $247 for that one contract. Now, I've used one contract as just sort of a general benchmark for creating a position, because the amount of capital that you're going to allocate to any particular trade is going to be a function of your account size. I'll just, I see a couple of people are suggesting here that the sound is breaking up. I'm actually on a phone here, so if you guys are listening through the computer, through some sort of a VoIP setup, then it may be such that you're having issues with the internet. But anybody that, I don't know, maybe Elanit, you can just kind of acknowledge on your end through the chat box whether or not I'm still I'm sounding okay. It may be just something that's isolated. Okay, it looks like somebody's answering the question here. Okay, so I'm going to just continue here, guys. Sorry for the interruption. So again, what we're looking to do is we're looking to capitalize on what we believe to be a move to the upside on the U.S. dollar against the Canadian dollar, and ultimately we're going to buy a call option that has a strike price relatively close to where the pair value is trading at 103.35, and we're prepared to pay $2.47 for that. Now you can see that I'm sticking with my rules that I want to purchase this call option that gives me at least out until September to participate. And the reason why I do that, it's not because I necessarily believe that it's going to take that long for this move to take place. I mean, anybody that's been watching the markets, particularly today, knows how well we've done on this Canadian dollar trade just in one day. But the fact is, I'm erring on the side of caution, because if we have a little bit of a hiccup, if the trade goes against us for even a month, we know that we have all the way out to till September for the move to turn around and go in our favor. So it's more so from a risk management perspective that we're giving ourselves time. At the end of the day, if this moves in our favor in a very short period of time, we're locking in and managing profits right away. So we may be out of this position in its entirety by the end of next week, depending on what's going to take place. The idea is that when we buy this call option, as you can see by my arrow here, we have an unlimited profit potential. We have a risk exposure limited to the $2.47 per contract that we purchase, and we have an unlimited profit potential. So when we go and we purchase this call option, or if we were bearish on a particular pair value and we were purchasing a put option, we recognize we have a limited and identifiable risk exposure, but we have an unlimited profit potential. And once again, in saying that, what we're doing is we're looking at our price charts, we're establishing an entry, and what we would do is we would establish some key technical levels whereby we would look to manage our profits. So ultimately, target number one, based on my chart, might be in here around the 106 level. Target number two might be in here around the 108 level. Okay, so we would still be exercising a sound approach to managing our trades, and say we had 10 contracts. When it hit target number one, we might sell 5 contracts, move our stop to break even, and then ride the other half up to 108, sell 3, and so on and so forth. So once again, you want to make sure that you are still exercising a very sound approach to managing your trade, despite the fact that you have a limited and identifiable risk exposure. You don't want to let any profits that you have turn around, and you don't want to let this pair value turn around and take away any profits that you may have enjoyed over the last move in that particular pair value. Now, some people might be looking at, again, the price of this option contract at $2.47 and believe that it might be a little expensive. So one way that we could actually offset or mitigate some of that cost is by creating a bull call spread. Now, a bull call spread is essentially a strategy whereby we're still looking to capitalize on a move in a particular direction. So in this case, we're still bullish on the U.S. dollar against the Canadian dollar, but what we want to do is we want to try to offset some of our costs. So what we do is we still look at that 104 call option, and we're still looking at paying $2.50 for it. But in order to offset some of that cost, what we're going to do is we're going to sell an option contract at a higher strike price. So as you can see here, what I've done is I've bought the September 104 strike call options, and I've paid out $2.50 or $250, and I've sold the September 107 strike calls, and I've collected $1.38 or $138.
Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.